Welcome to Growth Investing Mastery. This video will look at making decisive purchases of growth stocks. As a reminder, this is not investment advice or recommendations to buy stocks. The purpose of this video is to learn how to make decisive decisions to enter a stock. We look to make a yes or no decision on the company. To an outsider, our strategy can appear reckless or haphazard. However, our strategy is grounded in efficient research and an effective process that gets results. As of our portfolio update on August 7th, this channel was up 56% year to date and 284% since the start of 2024. Our viewpoint for deciding to enter a stock should be similar to that of a Shark Tank host. A company is coming in front of us to present, and they need to make a clear case why this is the best place for our money right now. To enter this company, we have to sell something else from our holdings, which we already have conviction in. At the end of the process or interview, we're looking to come to a yes or no decision. But sometimes we end up on the fence, and a company can become a watchlist company. Ideally, what we want is an easy yes. It's one of the best ideas we've heard in a while. The numbers and narrative fully check out. We want to document our decision with a 1 or 2 sentence conclusion. Here's an example for a business we like. The business sounds booming with strong quarter-over-quarter accelerations in the financials. For a company we don't like, we might write something like, the guidance they gave is weak and it makes no sense. Let's now talk about time boxing our research. Our investigation into a new company should be time boxed, and 2 hours is more than enough to get a full look at the company. We do approximately 15 minutes of financial review, and then we do about 30 minutes of product research. We can use AI tools such as Perplexity to ramp up on product research fast, and I have a video on that topic as well. Followed by that is 1 hour dedicated to reviewing the latest earnings transcript for this company, and we want to review it carefully. It's typically about 10 to 15 pages, and you can usually get through reading it in about 45 minutes. But I want to emphasize going through it carefully, so I laid out 1 hour in our process here. At the end, we have a miscellaneous follow-up. This could include going to the company's website or checking out some smaller details about the company. We really want an open mind going into this process, and we want to appreciate the uniqueness of the company. While we're time boxing our research, we don't want to put the company in a box. Most of the time, we will know if this company is a yes or a no. And it's okay to take time making the final decision. We can review the pros and cons and sleep on it for a night. The actual decision doesn't need to be rushed, but we do want to time box our research. One important tip is do not consider what we will sell yet. Just decide yes or no if we want to be in this company or not. It's important to keep in mind that buying a stock is not supposed to be a huge decision. It should be frictionless, and we'll be starting with a small position most of the time. Let's now step back for a moment and consider the categories of different stocks in our universe. Stocks can exist in one of the following states. They are a company in our portfolio, they're on a watch list, or they are untracked. We prefer to keep our watch list small with stocks that we may buy soon. If there's no chance to buy the stock, then why are we observing it? And this is often a common mistake where somebody might have 50 or 100 names on a watch list, and there's no real intent to buy. And following that many names will take up a ton of cognitive space, and it's also a lot of noise to look at every day. We do want to look to add new names to our watch list, but we also want to prune the list continually. And when we've decided we won't enter a stock in the near term, that's when we need to prune the stock from our watch list. Let's talk about a common mistake with watch lists. Continuing with the shark host analogy, we cannot reach a yes or no decision as the Shark Tank host. And instead of investing now, we ask the participant for their contact info while we think it over. And we get their social media and we follow their business account on Instagram. Some weeks later, we see they had a viral post and their product's really taking off. But still, we don't reach out to the person. And over time, we see this Shark Tank participant doing better and better. And it really starts to eat away at us now as we calculate how well we would have done if we just invested at the start. And going back to our stocks, the equivalent here is just to stare at a stock on your watch list and see the green bars every day. But the problem is our fear of missing out, or FOMO, is starting to go off the charts now. We first saw the stock when it was $50, and then it went up to $60. Now it sits all the way at $80. It ends up becoming a huge story in our head as the stock that got away. And after all, we knew it would happen like this. We literally called it all along. If we ever find ourselves in this position, we must do one of the two things. The first is start a position, or the second is remove the company from the watch list and stop following them. Let's now talk about the watch list signal, or what is a signal to move a company from the watch list to our portfolio. And you want to keep your eyes open for this signal that a company should be moving from the watch list to a portfolio company. Here's a classic example. You noticed a watch list company is rising and it starts to bother you. Being bothered is the signal to investigate more here. And we want to step back and examine the situation deeply. We realize that this idea feels like it could be the next big thing, and it starts to feel like we're missing out. Oftentimes in this scenario, we can envision the company with a clear path to being a much larger company. And our FOMO barometer on this stock is starting to rise. And keeping in mind, our watch list is already vetted for numbers and narrative based on our definition of a watch list. We don't have any random names on our list. The best course of action here is to start a small starter position in the range of 0.5 to 1%. And we don't care too much about which specific price we're buying it at. We want to establish a small position. And this really helps with two different things. It immediately dissipates that FOMO, and it acts as a forcing function to learn more. Now that we are a shareholder of this company, it is only natural to research more about the company. A lot of times when I do a write-up on a stock, I'll end with a sentence similar to, I started a small position while I learn more. And the big key point here is we are free to change our mind at any point. Nothing is permanent. We may decide later we got a little bit too hyped up on this company, or we bought too many shares, and we can either trim or sell the company back if we change our mind. Now we'll take a look at what's next after we've started a position, and we'll assume here you've started a 1% position in a new company. We want to continue the research. This could be something like reviewing the transcript of a tech conference they presented at, or we could check their S1 IPO document. We could read the latest 10K filing, or if they're a consumer company, we could read reviews of their product on Reddit. We use a flagging system for new info we find out about the company, and it falls into categories of green, yellow, or red, just like a stoplight. Flags can either be light or dark, and an example is a dark yellow flag is a big concern, but a light yellow flag is smaller. And when we find green flags, it leads us to increasing our position typically, while finding yellow or red flags is a good reason for trimming or selling a company. Here's a few basic rules. The more we learn, the more we like. In that scenario, we add to our position. What if we discover 2 new yellow flags about a company? In this scenario, we typically like to trim back part of our position. And this accumulation of yellow flags, or discovering a red flag, is a clear signal to sell. In example 1, we find information about a company which causes us to sell. About a year and a half ago, I had a position in Aspen Aerogels, and they showed strong accelerating financials and a product catching on in the emerging industry of electric vehicles. Our product research indicates they may have a big competitive advantage, and their product was basically a gel which goes over a battery in an electric vehicle. But we discover something a bit unsettling about this company, and we see that the company has a loan from the Koch brothers. Right away, this is a yellow flag, as we know the Koch brothers are notorious corporate raiders. And going down a rabbit hole on the deal that Aspen signed, we discover that the Koch brothers have incredible leverage over the Aspen Aerogels business. Reading between the lines in the latest earnings transcript, we discover an analyst indicated the management team needs approval from the Koch brothers on decisions. And we get even worse news. We look up the rates of the loans, and the business signed loans came with terrible rates and heavy restrictions on the business. We end up trimming our position in half as our confidence has decreased. We try to find a way around the loans issue, but we realize the company just signed so many poor loan deals, their chance of success is limited. We close our position here after a yellow flag turned into a red flag. Let's now take a look at example 2, where we build up a position fast. And there was a recent comment from a previous video about how do we build a top confidence position so fast. And some longer time listeners noticed I built a position in IRIN quite quickly. It went from a 6% position in one portfolio update to an 18% position in the next. And part of that reason was I sold a number of stocks for earnings season, but we'll look at the process more generally here for how you build up a big position fast. About a year and a half ago, we started looking at Astera Labs with symbol ALAB, and we find a company which IPO'd recently in the AI hardware space. Right away, we're encouraged because we know AI has a big tailwind behind it, and we've never heard of Astera Labs before. And it's pretty wild how I found this stock. I was in Yahoo Finance, and on the sidebar, it was in that companies similar to, where it shows 5 companies similar to the one you're on. I've never found a company this way before, and I don't think I will find many companies this way, but this is how we found Astera. We noticed looking at this stock chart, the company had its share price cut in half, but we cannot find any obvious reason. When the company IPO'd, it started around $80 on its first trading day, but now it's been sitting in a range of about $40 to $45. And we take a look at their financials. We do product research, and we read through the first transcript, and all of that reads well. We follow our process to a T on this one. And we take a small starter position right away, and I put right away in all caps. This is very key. We don't want to observe the stock and think it's going to do well, and then just let FOMO build up. Our next step is to review the S1 document, as this company is a recent IPO. And reviewing the S1, we like what we find. We notice in the S1 there's a who's who of top hyperscalers and investment banks backing this company. They seem to have all the right connections in the industry. Next up, we review an investor tech conference from Astera, and we're starting to like even more of this story. Now we've built up our confidence quite fast, and we start to build out our position further. It's become a medium confidence position already. And we still haven't seen this company report earnings before, but the company reports earnings and it exceeds our expectations, and we then bump it up to a top position. We find endless green flags with this company. Whether it's the S1 or the latest earnings, the tech conference, it's all really good material. We simply can't even find a yellow or a red flag anywhere. And this is a case of that phrase, the more we learn, the more we like. And that's when we can start building out our position. And lastly, I wrote here, another company failing can present an opportunity to build out our Astera position. Oftentimes, investors will get really upset when a top confidence position underperforms. But we look at it a bit differently. A company failing means a huge opportunity in another company. Let's take a look at our conclusions. And taking decisive action on making additions to our portfolio is a great idea. If we find a highly promising stock, we must take a starter position. We cannot stay on the sidelines, letting our FOMO build and watching the price rise. The starter position removes FOMO, and it acts as a forcing function, causing us to research more. We can always change our mind, and our buying process should be friction-free. It's not a big deal to buy into a stock. And we frequently reevaluate our confidence in a company, either adding to or trimming from a stock. And we will do a video coming up on the opposite side of the coin, which is decisive selling. So stay tuned for that video. And this concludes the video on buying a stock fast. And I'd definitely be interested in feedback on this video if you want to leave a comment and let me know how you found it. As the final reminder, this is not investment advice or recommendations to buy stocks. Thank you.